I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. Dividends. What are they and how are they used? Dividends are cash or share distributions a company gives to its shareholders. There are various items investors should know about dividends and dividend paying stocks before they invest in them. Most of this information can be found for free online. For example, Yahoo Finance has it under its summary or statistics tab, or you can go to Seeking Alpha and get most of it under its dividends tab, or with your broker like Fidelity, TD Ameritrade, or Charles Schwab. One important thing to know is the dividend amount, which is the amount of money a company will distribute out to its shareholders the next time it pays out its dividend. Then you have the dividend frequency, which states how often a company distributes out a dividend for 1 year. And then you have the annual payout. This simply shows the total dividend amount that is paid during the year. This is done by multiplying the dividend amount by the dividend frequency. For example, if a company pays out 10 cents every quarter, the annual payout is calculated as 10 cents times 4 for a total of 40 cents. The dividend yield is the amount of money shareholders receive as a dividend each year and expressed as a percentage. For example, if a company has a dividend of $5 per share and the share price of the company is 50, its yield is 10%. Some companies will increase their dividend every year, effectively increasing an investor's return on investment. Some have done it for decades and are very popular among dividend investors. These are known as the dividend aristocrats. But increasing yields can sometimes be deceiving because a company can appear to have high yields or increasing yields, which appears to be good, but it's not supported by fundamental factors. I'll explain this in further detail later in this video. The payout ratio shows how much of the net earnings are paid out as dividends. This ratio is calculated by taking the annual payout expressed as a dividend per share and dividing it by its net earnings expressed as a company's annual earnings per share. For example, if a company has an annual dividend payout of $2.50 and it has an annual earnings per share of $3.50, its payout ratio is equal to 0.71. Ideally, a lower payout ratio is better. These ratios can vary by sector or industry. A ratio over 1 indicates that the company is paying out more in dividends than what it's making in earnings. This can be a red flag for investors because this type of payout cannot be sustained long term. The dividend growth rate is the percentage of growth the company's dividend has over time. It is calculated on a year-over-year basis. You simply take the dividend of 1 year, we'll call it X for this example, and subtract the dividend of the previous year, we'll call that one Y. Then you divide that value by dividend X, then multiply that value by 100, and you have your year-over-year dividend growth. This table shows what the year-over-year growth would be for these 3 years. There are several ways to calculate the rate of growth, but we can use the simplest method and take the average. For example, here we just add up all the year-over-year growths and divide by the number of years being evaluated, giving us a year-over-year growth rate of 9.7%. There are 4 stages to a dividend distribution, which consist of 4 dates: the declaration date, the ex-dividend date, the record date, and the payout date. The declaration date is the date a company announces its next dividend amount, ex-dividend date, and payment date. It is also known as the announcement date. Ex-dividend date is the date that determines which shareholders will receive a dividend. If you purchase shares before the ex-dividend date and hold the shares until the record date, you will qualify to receive a dividend. If you purchase the shares on or after the ex-dividend date, you will not qualify to receive the dividend. For example, let's suppose the ex-dividend date is on the 10th of the month. If you buy shares on or before the 9th and hold them until after the market closes, you will qualify to receive the dividend. But if you buy shares on the 10th or after, you will not qualify to receive the dividend. The record date is also known as the date of record. It is the date a company uses to determine who is a shareholder of the company and who is entitled to a dividend. This typically occurs 1 to 2 days after the ex-dividend date. The payout date is the day a dividend payment is paid to an eligible shareholder. Let's suppose a company declares a dividend of 50 cents on June 1st to shareholders on record on July 7th, and the payment will be made on August 9th. An investor must purchase shares of that company no later than July 5th, which is the day before the ex-dividend date, in order to be on the books on the date of record in order to receive the 50-cent dividend on August 5th. Remember earlier when I mentioned an increasing yield might not be that great if the fundamentals are bad? Let's suppose a company has been paying an annual dividend of $2 per share for the last 3 years, and its dividend has been increasing from 2% for the first year to 6% to the third year. Using the yield formula, we can see that the increase in yield is due to the drop in share price. But in order to maintain the 2% per share dividend, the company has to take on more debt, and its payout ratio has increased significantly. This could be due to decreased cash flows, bad company management, economic factors, or many other reasons. But in order to maintain the $2 per share dividend, the company will need to increase its payout ratio or take on more debt, leading to further fundamental problems for the company if they cannot repair the cash flow issues. That phenomenon is known as the dividend trap. It is attributed to declining share price due to fundamental issues and a company that has a dividend payout that remains unchanged. It leads to high payout ratios, high debt, and if the fundamentals are not corrected, it will ultimately lead to future dividend cuts or suspension of dividends. Some people might argue that higher dividends are good and the share price won't go down by that much in order to maintain the same dividend payout. But in the example I gave earlier, you can see that in order to maintain a $2 per share dividend and a 2-point increase per year in the yield, the share price decreased from $100 per share to approximately $33 per share. That is a decrease of 67% in your investment. Dividends can vary from company to company and sector to sector. The most common dividend-paying stocks are found in the utilities, real estate, materials, financials, healthcare, and oil and gas sectors and industries. Things to keep in mind or look for when choosing dividend investments. Is a company profitable with increasing revenues and free cash flows? Has it consistently paid a dividend for at least 10 years? Has it had dividend growth along with its share price? Is the payout ratio less than 0.7? Or is the dividend yield at least 3 to 5%? Make sure you know the ex-dividend date for a stock you want to invest in, and be cautious of any signs that might indicate you might be buying into a dividend trap. It's also important to be aware of other impacts to your financial investments when it comes to dividends, such as tax implications, the effects of interest rates, and/or bond yields. If you found this information helpful and would like to see more videos like this or get notified when I release a new video, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see videos on a specific topic. Thank you for watching and have a great trading week.